Alibaba is down 8.5% to open. They beat on earnings. They beat on revenue. Why are they down? In this video, we're going to tell you why they're down. We're going to explain why this is an opportunity and a good thing when stocks go down. Mo, what did they report versus what was expected?
They reported $2.14 versus $2.09 expectation. Revenue came in at $30.78 billion versus $30.73. That's a beat on top and bottom line. I have a lot more in the press release. Good things, you would think.
They also announced
down 10%.
Down 10% now?
Down 9.9%.
So, guys,
10.07%.
Now they also announced a dividend.
Yeah.
So your reaction's exactly what I wanted to hear.
Yeah.
Now, the reason they're down, though, is because the U.S. and China relationship is a little strained right now. Mm-hmm. And people are worried about this. And guys, whenever a stock falls, and this stock is down big time from its all-time high of 320 back in October of 2020.
Can I inject something?
Yes, please do.
You said it's a little strained right now. It's been strained for quite some time.
You're 100% right.
You know.
You are 100% right. But I look at 320 down to $79, $78 per share. That's a big drop. The question is the bad news now, because when it started to drop, all of a sudden it became all about the fact that, do you realize you don't even own this company? It's like, guys, that's always been the case with China. Right. I loved hearing it. I was like, wow, this is incredible. And we started buying Alibaba, high 100s, and then dropped down, and then I got a little bit of lucky. So I'm down. I think my basis on it right now is like 120.
That's about mine.
So I'm looking at going, okay, I'm down a lot. Guess how much I'm worried about it?
Not very much.
Not very much at all.
A long-term play. I mean, not only does the company fundamentals have to get better, but also the U.S.-China relationship has to get better. So it's going to be a long-term play. And honestly, I don't even know if that needs to happen. Because
that's
the majority of what they do is in China.
Yeah, so remember, guys, we own the stock. Doesn't mean you should buy it, okay? What you need to do, what we're trying to teach here is a process to look at companies. Now, I believe that China, and everybody's like, oh, they're socialist. I get that. But are they more socialist today than they were 20 years ago? No. Are they getting less and less socialist? Absolutely. And that's where I look at it saying China's got the fastest growing middle class. They like making money. And Alibaba will be a direct recipient of a booming middle class in China. Now, did their population decline last year for the first time in 60 years? Yes. But when you look at the number of wealthy people in this world, millionaires and billionaires, the most are coming out of China. So that's something to keep in mind here, and Alibaba will be a direct recipient of that. Now, the dividend. This is the stupidest thing in the world to do. And I know there's a lot of people out there who love dividends. Guys, if the stock is cheap, and we'll go through the numbers to sit there and determine what the stock should be worth based on the future projections. If the stock is cheap, don't pay a dividend. Buy back a ton more shares. Buy back as many shares as you can. Decrease that share count. Don't pay a dividend. Why are you paying a dividend?
It's a big number, too. $2.5 billion.
What, the dividend? Mm-hmm. So for a company that's, it's about 1%. It's about 1% dividend yield.
Why? That's not typical of Chinese companies.
Yeah,
what are they trying to do?
Neither is buying back shares.
Stock go up in the United States or something?
Well, maybe so.
It could be.
That could very well be it.
I do think that a lot of dividends are psychological.
No, it's mostly psychological because people look at dividends. I'm on Twitter all the time, and people look, and they'll deny it till they're blue in the face, but people look at dividends as free money. It is not free money. You're taking money out of this account after it's been taxed, putting it in your account and being taxed again. It's double taxation, and it's also, if the money's sitting in the account, and somebody had an argument with me on Twitter recently, and luckily a lot of my followers came in and like, what are you talking about, pal? He sat there and said that the money coming out of the company does not decrease the value of the company. Oh. I was like, so if two companies are exactly the same, one has $100 billion in cash, one has zero, they're worth the exact same amount of money? No, of course not. So I look at these dividends and so let's go over some of the things that are going on in the quarterly report, in the quarterly results.
So revenue increased 9% year over year.
Wow.
Income from operations increased 34% year over year.
Wow.
There's some big numbers down here. This was
some of those subsidiaries.
Yes. So this Taobao, because they broke into 6 different groups. Remember that?
They're talking about doing that. Yep.
Yeah. So this one went up 20% year over year. Alibaba International Digital Commerce, increase of 28% year over year. Wow. During the quarter, revenue from their digital commerce increased 53% year over year. Wow. Everything was growth. Local services group, 16% year over year. So like I was going through this earlier today, and I'm like, man, everything was growth except for the stock price, really.
So, you look at our 8 pillars here, Mo.
There's one thing that threw me off. Yeah. It's cloud intelligence.
Yes.
2%.
That was only 2%. I saw that. And they're also talking about not splitting that off because they're sitting there saying, listen, we think it might be better to keep it in-house, but I don't know what the exact decision is. Here's our 8 pillars. Here's one thing I do like. Net income's down 2.25 in the last 5 years, but free cash flow is up $8.5 billion.
That's big. That's good.
Yeah. So I look at that now. Obviously, again, you don't buy or sell based on the pillars. It tells a story. So one of the things you have to understand is why is net income down 2.25 and cash flow is up 8.5? I would like it less. I like this version. I don't like it when that's flipped because it's easier to manipulate that net income number than the free cash flow number. They've bought back a few shares. This ROIC is bad.
I think it's a little skewed though.
I think so, but I do like 5-year PE of 15, 5-year price of free cash flow of 12. Mm-hmm. So I'm looking at this going, okay, guys, you're a growing company that has a lot of potential and you're paying a dividend with this kind of cheap stock. What are you doing here?
I know.
Let's see what analysts are saying about the company. So we're going to analyst estimates here. They're expected to make, by end of March 2024, $9.36 per share, going to 12. So not huge growth, but at $9.36, the stock's at $78. You're talking about less than, you're talking about 8.5 times earnings. 8.5 times. Yeah. Let's look at revenue. What do analysts think about revenue?
Less than I thought.
Actually, more than I thought after I looked at the EPS. Yeah, because I thought the EPS was not as much as I would have thought there. So revenue growth from 135 billion at the end of March of 2024 to 170 billion. So over 4 years, growing 35, so growing around 25%. Yeah, not much. But revenue growth of 9% year over year, that's pretty huge.
Yeah.
Okay. So I guess the question to be asked is, what's the right price to pay for Alibaba stock?
What is the right price to pay?
So for those, before we get into the actual numbers of Stock Analyzer tool, 2 things. One, if you like this software you see so far, we didn't even talk about the community of 1,000 investors here, but go to everythingmoney.com. I make an offer that is absolutely stupid to say no to. Free 7-day full access trial. You can try everything, all of our tools, our community, 7 days for free, so go check it out. But when it comes to this, when it comes to analyzing companies, if you're this came up in the community just the other day. Like, Paul, I was more conservative. Even Mo said it yesterday. I was more conservative in my assumptions up here because I don't want to own the company as much because I'm worried about it. Guys, don't take it out on this area. That's why we have low, middle, and high. Be conservative. And the low side, middle, say, okay, what do I really think is going to happen? And high side, what do they really crush it? Be conservative in your desired return. This is your margin of safety. If you only want the company, if you're going to make a killing, put your high numbers here. That's where I would do it. So, Mo, when was the last time you did Alibaba analysis?
The last time was May.
Mine was October 3rd.
Okay.
I'm going to pull it up. Now, what were your assumptions back then?
I did 5, 8, and 11.
I did 5, 8, and 12. I did a little bit higher than the difference there.
Okay.
Profit margin?
15, 19, and 23.
That's what I did. What'd you do for free cash flow?
Same, 17, 22, 27.
Okay. PE?
16, 18, 20.
Same with me.
Yep, 16, 18. And then for my desired annual return, I did 12, 14, and 16.
So I have 20 in there just to show how ridiculous that is. But I agree with you. 12, 14, and 16. So guys, we went through that quickly. We did our revenue growth assumptions here, low, middle, and high. I think 5% revenue growth is low for an expanding market like China.
Yeah.
Okay? I think 8% seems reasonable with all their divisions and how much the Chinese economy is growing. And 12%, they absolutely crush it. Profit margin, even though I went based on history, even though I think their history is going to get better, as they get bigger and bigger, their profit margins should increase. And their free cash flow has been remarkably higher than their profit margin. So that's why we did a higher free cash flow here. Now for the PE and price of free cash flow, it's based on the end of 10 years. Where do you think they'll be selling for at the end of 10 years? What kind of multiple? And I thought to myself, you know what? Biggest e-commerce site in China, probably has a premium to it. So I put 16, 18, and 20. And my desired return, if this was a US company, I probably would put 10, 12, and 14. But I need a little bit more premium for having that China risk, right?
Yep.
So we hit the analyze button, guys. Boom. Now, here is where I am with Alibaba. Now, it's all green. It doesn't mean go out and buy. If I have a low price of 100 to 122, a high price of 240 to 280, a mid price of 160 to 180. That's, guys, if I buy at today's price and my low assumptions occur, if they actually occur, I should make about 19% return. If my middle assumptions occur, 28%, high assumptions occur, 38%. And that can sound confusing because you're like, well, why don't I buy this? Well, because it could still not happen and there's a lot of risks involved. Yeah. What were your numbers, Mo?
Basically the same as yours, except on the high end, because you had a revenue growth number a little bit higher.
That is correct.
Yeah.
So guys, this is Alibaba. Again, check out our software, check out our community, everythingmoney.com, free 7-day full access trial.